Tulip Mania crash of 1637. In the Dutch Republic, tulip bulbs became so fashionable that people began trading them for prices higher than houses. Merchants, farmers, and even servants jumped into the market, hoping to resell bulbs at a profit within days. Contracts were signed on credit, and nobody seemed to ask what the bulbs were actually worth. When buyers finally hesitated, prices collapsed within weeks, leaving traders holding worthless paper agreements. It stands today as one of the earliest recorded examples of a speculative bubble, showing how emotion can override basic economic sense long before modern markets even existed. The Wall Street crash of 1929. Throughout the 1920s, the American economy boomed, and ordinary citizens began borrowing money just to buy stocks, believing prices would rise forever. Banks extended easy credit, and speculation replaced careful investing almost entirely. In October of that year, panic selling began, and within days, billions of dollars in value vanished from the market. The crash didn't just wipe out investors, it triggered bank failures, mass unemployment, and ultimately the Great Depression that reshaped the global economy for a decade. It remains a defining lesson in how debt-fueled optimism can turn into widespread economic collapse. Black Monday of 1987. On a single day in October, stock markets around the world fell sharply, with the Dow Jones losing over 20% in hours. Unlike earlier crashes, this one was accelerated by computer-driven trading programs that automatically sold stocks once prices dropped past certain points. Those programs triggered more selling, which triggered even more programs, creating a spiral that human traders struggled to stop. Although the market eventually recovered within about 2 years, the event forced regulators to introduce circuit breakers, pauses designed to slow down chaotic trading. It marked the first time technology itself became a central character in a market collapse. The dot-com bubble burst of 2000. During the late 1990s, internet companies attracted enormous investment, even when many had little revenue or a working business model. Investors were drawn in by the promise of a new digital economy, pushing stock prices to levels disconnected from actual company performance. When reality set in and profits failed to appear, confidence evaporated almost overnight. Countless startups collapsed, and even established tech firms lost most of their market value within months. The crash reshaped how investors evaluate technology companies, placing far greater emphasis on sustainable earnings rather than future promises alone. The global financial crisis of 2008. This crash originated not in the stock market itself, but in the housing sector, where banks had issued risky mortgages to buyers who often couldn't afford them. These loans were bundled into complex financial products and sold worldwide, spreading the risk without anyone fully understanding it. When homeowners began defaulting, the entire financial system started to unravel, and major banks faced collapse. Stock markets plunged as panic spread across the globe, leading governments to intervene with massive bailouts to prevent total economic breakdown. It exposed how deeply connected modern financial systems had become, and how a crisis in one sector could threaten the entire world economy. The COVID-19 crash of 2020. As the pandemic spread across the globe, governments imposed lockdowns that halted travel, shut down businesses, and froze economic activity almost overnight. Investors, uncertain about how long the disruption would last, pulled money out of markets at a stunning pace, causing some of the fastest stock declines in history. Yet the recovery was equally unusual, driven by massive government stimulus and record-low interest rates that pushed investors back into stocks within months. This crash demonstrated how a health crisis, something entirely outside the financial system, could shake markets just as severely as any banking failure or speculative bubble.